going on. But well, here, let me kick off. We're just a minute over, so we'll have some folks keep trickling in. But for those that are with us now, thank you for joining us for the Exit Advisors Town Hall series. Today we've got Trevor Shakiba from Shakiba Capital. And Trevor, I think it was almost exactly a year ago that we had you join us, and right when the market was getting very turbulent and there was a lot of uncertainty. So it's great to come back full circle, hence the name, where we were, where we are, and where we're going. Looking forward to hearing from you today. Before I kind of hand things off to you, I'll give a quick overview of Exit Advisors. For those of you that do not know us, we are a boutique M&A advisory firm located here in Houston, but we do work kind of across the country. COVID's actually made that even easier now that everyone's remote, but we really focus on the lower middle market and prepping our clients, these companies, months or years in advance to their sale, to get all the housekeeping, the financials in order, identify issues, and help create value for when it comes time to exit, whether you're selling to a large strategic competitor or private equity company. We really tailor fit our strategy and our in game with the buyer. Our process, you'll see in the next slide, just a quick overview. Things like we do today, we really focus on education, helping educate entrepreneurs on what this process looks like, not just when they're looking to sell, but all the prep work that goes into it before, and then even when the transaction's done, when we leave off, and hopefully we introduce you to people like Trevor who can help you maintain your wealth and your capital once you have a full liquidity or a partial liquidity event from your business. Lots of discovery work, which I was just mentioning, kind of identifying your current state assessment, where you are, what you need to do to get to your number, the prep work, the pre-due diligence that you're ultimately going to go through with a buyer in very, very rigorous detail, and then going through the execution process with legal and third-party accounting firms that are going to conduct quality of earnings analysis, just everything to get you ready. We've got a really robust team with a lot of expertise, across the board. Myself, our two managing partners, Al Danto, Gary Cooper, and then Casey Bright. So Trevor, let me pass it off to you. A quick point, you've had a very interesting kind of roadmap going from Shakiba Capital, exiting that yourself, very, very significant transaction, and then starting, the Shakiba Group to starting Shakiba Capital. Why don't you give us a little overview and kick things off? And thank you for joining us.
Yeah, thanks, Andrew. I appreciate it. Thanks for everyone that's on, and thanks for the invite. I think it's interesting to look back approximately a year ago when we did this, and it was very, very different, right in the midst, probably the beginning stages of COVID, unprecedented volatility, and we're going to talk about that. It's always good to reflect back and see what you were saying, what you got right, and of course what you got wrong, and we had a little bit of both, and then to look forward. And obviously no one can predict or know exactly, but I think there's some interesting things going on. Little background about myself is right out of college, I went into finance, investments, financial planning, and basically built up the Shakiba Group, which was a wealth management financial planning firm. Did that from approximately 2003 to 2019. Decided to exit for any number of reasons and sell. I have a 6 and a 3-year-old, so that was a big part of it. But also, I think the financial services and wealth management industry is being disrupted. And so I'm going to talk a little bit about that and how I look at individual companies and why I like the disruption thesis. And And then in January, I always had an interest in real estate. Christina and I did, and we've done everything from single family rentals to development, investing in land. But it was really the tax advantages of large commercial real estate and multifamily in particular that got our attention. And the more we did it ourselves, the more we became interested and convinced that it was a great thing for individual investors to help them truly attain diversification. And I'm going to talk about that a lot as well, because when the market hits a black swan event or something like COVID or 08, 09, for example, you can be as diversified as possible in the market. So traditional diversification, large cap, mid cap, small cap, international, but that does not matter at all. You're going to go down with the market. And so that's a little bit about myself. Shakiba Capital is focused on multifamily opportunities, larger apartment complexes, 100 units or more. And I'm going to talk more about why real estate and why I think it needs to be a percentage of everyone's portfolio, and the advantages of that. Real estate's an asset class that no other investment asset class can replicate. So this first slide here, it just goes back, and this is exactly where we were, what we were talking about. We had no idea what COVID really was, how low the market was going to go. And it's just stunning to think about the uncertainty and the volatility at that time. And if you go to the bottom of this slide, there's a couple statistics here. Number one, we had the quickest correction that we've ever had, ever. So that's a 10% pullback or more. That was 7 days. We had the quickest bear market ever. So a bear market is defined by a 20% pullback or more. That was 16 days. And you can see literally from February 12th to March 23rd, a little bit more than a month, we saw a 35% approximate pullback like we've never seen before, ever, literally. We've seen the market go down more than that, 2001 and 02, but that was over a 3-year period. What made this exceptional, an anomaly really, was how quick it happened. And so our quote that we kept referencing, and I don't know if everyone believed it at the time, was this is going to end up being a once in a generation opportunity. And so you can see Warren Buffett's quote. I pulled that from his annual report in 2016. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. And man, if you want to talk about what we got right, that is where we got it right. Because you can see today, the Dow, and I would have never predicted this, is almost at 34,000. It's just absolutely stunning to me how quickly the market recovered from this unprecedented volatility and uncertainty. I would have, if you would have said, hey, the Dow's at 34,000, how long would it take to do that? I probably would have said 2 or 3 years when we were at 18. And I think probably pointing at the biggest mistake, at least I made individually and other people that I advised at the time, was I wasn't aggressive enough with trying to take advantage of these once in a generation price points for some phenomenal companies or the market itself. So next slide. Let's see here. So this is just a chart that actually was the impetus for doing this again, is First Trust Portfolios, which is a great follow, by the way, puts out phenomenal data. They showed each industry, along with large, mid, and small cap, what they did at that volatile period, and then the recovery. And what's really interesting, we talked about this, is typically out of a recession, smaller companies, mid-sized companies are going to lead the way. That happened once again. So you can see over on the right side, small cap has recovered 120%, the index 119.48. It got hit harder for sure. Large cap has lagged. So that's the S&P 500 index, which represents the 500 largest companies. And then it's just interesting to see the specific areas and sectors. And you know, what should you take away from this? I think probably the areas that got hit the hardest are the ones that were covered the most. I think one mistake we made in the webinar, or I made, was we were a little early on energy. I don't know if everyone remembers this, but there was that one period where energy actually went negative for a while. There was simply no demand anywhere, but you can see how much it's recovered now. And obviously the big winner here, if you look back, has been what I call COVID companies, the ones that have been online or were able to pivot to online, and technology in particular. So I just found this chart fascinating, absolutely fascinating. So next slide. And so this is just my opinion and thoughts. Now that I was telling the Exit Advisors crew, now that I'm no longer in that industry, I can kind of just say whatever, and you know, I don't have compliance or have to be careful. I think we're still in a bull market. I think it continues, but I do think we're in the late stages of it. Now, what that means, I have no idea. I mean, could it be another year or two? Absolutely. But I will tell you this, is historically bull markets end with acceleration, a blow off top. You'll hear some people say that, or euphoria. And I think we're starting to see that, right? A couple things I'd point: the GameStop fiasco, which was very, very interesting and intriguing, but that's a data point where it was like, wow, let's really pay attention. The other very interesting data point I saw, it was just a couple days ago, and I'm going to read this verbatim. This is a headline. Investors have put more money into stocks in the last 5 months than the previous 12 years combined. Again, very interesting. And I would just be careful with the stock market here. Is it possible we're going to go up another 10, 20%? Absolutely. But you know, it's obviously very different a year ago when the Dow was at 20,000 and now we're at 34. I think you're going to start to see rotation as the economy opens up from what I said, what I called before, COVID companies and growth, to maybe more emphasis on value and companies that are your typical dividend payers. I'm not completely out on technology or anything like that. I just think you're going to start to see a rotation. Same thing for technology. Look at where the NASDAQ is and look at the all-time highs that you're seeing for your FANG stocks, right? Facebook, Amazon, Netflix, look at Zoom. A lot of these companies are at some pretty crazy multiples. Obviously, international has lagged the US for a long time, a decade or more. Could we see rotation there? Absolutely. Here's the thing that I would say in 2021, I think you're going to start to see a return to fundamentals. They always have been important, but last year I think was such an anomaly that speculation was rewarded. I don't think that's going to be the case in 2021. And what I mean by that is that, you know, if an IPO comes out, is it going to double in 2 weeks just because it's an IPO like Airbnb? Maybe, but I don't think that's sustainable. So nothing's really changed here, in my opinion. As a certified financial planner, this is what I used to advise clients. Long term, it's pretty simple. You want to own great companies that are run by really smart people that are going to grow the profits, top line, increase the dividends. And if you do that, whether that's through mutual funds, ETFs, or the individual companies themselves, you're going to be very successful. Near term, you're going to have ups and downs and volatility, but focus on who's growing. Top line, I think, is really important. Profitability. And then Warren Buffett always talks about a company's moat, meaning, do they have a competitive advantage, and you know, is that sustainable long term? So next slide. And if you have questions, please put them in the chat box. I'll open it up at the end as well. But here's the big thing, and the mantra that I'm sure everybody has heard is don't fight the Fed. And so we saw the Chairman Powell came out and said, hey, interest rates are going to be low for the foreseeable future. And so there's a lot of arguments on what that potentially means for the future. We'll talk about that a little bit. But at the end of the day, with interest rates as low as they are, that provides a great baseline for the market and for small business and for businesses in general moving forward. And so look, historically, you need to pay really close attention to interest rates and the yield curve. And the yield curve, what I mean by that is long-term debt in comparison to short-term debt. Most recessions, not all, have seen an inversion of this. 08, 09, I don't believe was the case. But, and I guess I probably should have said something else besides right behind, because typically when you see that happen, a recession has been, I don't know, 12 months or 24 months behind that. So I think that's the most interesting thing that's going on right now is interest rates and when those are going to start going back up and what that may mean for inflation, for example. Bonds, I think, are in a terrible position. And this is one of the biggest myths out there for individual investors, is that if you have X percentage of your portfolio in bonds, that percentage of your portfolio is safe, quote unquote safe. And that is not the case. Bonds can and will go down. They have. The next chart is going to show that when we flip over to that. But, you know, I pulled this from Warren Buffett in one of his recent letters. Fixed income investors, whether pension funds, insurance companies, or retirees, face a bleak future. And the point there is that interest rates are going up, will continue to go up. It may not be quick, but that provides a very difficult environment for bonds. So pay attention to how long those bonds are that you own. I would really focus on keeping it shorter duration. And in my opinion, that this is different from 08, 09. I think there are beginning to be data points which point to a return of inflation. Late 70s, I'm not predicting that, but I do think based on what's occurring from the Fed and how that's different from 08, 09, that inflation is on the horizon. Here's the point, kind of going back to fundamentals. No matter what, stay diversified. So if you've made an absolute killing this past year on COVID companies, tech, you put a lot of money into the market in March and April last year, you need to consider rebalancing and taking profits. And even if that's going to present some taxable gains, that's okay. Don't let the tax tail wag the investment dog, especially since capital gain rates might be going up with this new administration. And remember what diversification is. You're basically saying you're never going to make a killing, but you're never going to get killed. And the key to building wealth is it's a long game, right? You're not trying to double and triple your money or whatever, like GameStop. That's just pure gambling. The other point I made earlier is that, in my opinion, especially after being an asset manager for 15 plus years, true diversification is not just having an allocation within the market. Because again, when everything hits the fan, just because you're diversified in the market, that is not going to hold up. Everything is going to go down when we have a COVID and 08, 09, insert your panic du jour there. And like I said, no one has ever gone broke taking a profit. Make sure that you stay diversified. Taking profits is a really good thing. So next slide, this shows what I was talking about with bonds. Just to put this in perspective, if you look here at the top, I think it was the 10-year bottomed in August of last year. From that point, that has gone up over 120 basis points. You can see that at the bottom of that chart. That is a lot. And as you might imagine, treasuries, US corporates, they are negative, not just by a little bit, especially the 7 to the 10. That's negative 8%. Now, some of the stuff that's preferred or high yield or junk has done better than that. But my point here is that bonds are in a very challenging position looking forward. So next slide. Real estate, look, this is the shameless plug. That's what we're doing now. I'm a huge proponent of it. I'm going to talk about why I like it on this slide and in the future. But real estate is, it's what it says. It's a real asset. And that's very, very important, I think, in this environment, especially when you consider that we have a major affordable housing problem. And so here's some very interesting statistics. Existing homes have dropped 32.5% year over year in February. So inventory is at an all-time low. Days on market, lowest ever, 20 days. Of course, you would think on the other side, we're at the highest median home price at almost $335,000. You add to that COVID and all of the different things that have made lumber and building difficult. Lumber, I never followed that before, but I follow it now. It's up, it's approaching 200%. That 180% is old. So that's just unbelievable. It's difficult to build homes. So we've got a major problem in affordable housing. We're not building enough homes. There's not enough multifamily. And then the winter storms we had also slowed everything down. So I absolutely, for those that are on the webinar here, especially the business owners that work with exit advisors that may be exiting this year or next, this should be part of your portfolio. It's a fantastic hedge against inflation, whether it's single family or multifamily rents. You can obviously pass that inflation on. I'm not a huge proponent of single family rentals, but I don't think that's necessarily a bad investment. I just think it's difficult to get scale. And when you own a single family rental, you've got one resident. And then if you don't have occupancy for 1 month or two for sure, you're going to be in the red. So, that a lot of people do single family because that's what they think they can afford. But I would challenge that assumption. And I think the minimum that most people should be looking at is at least 36 or 48 units through a partnership. And that's what we're doing at Shakiba Capital. I think multifamily presents all of those advantages. And the thing I like about affordable housing, and I'm going to talk about this here in a second, is it cannot be disrupted, meaning people will always need a place to live. Can't be disrupted by Amazon or technology, even COVID. Office and hospitality were certainly disrupted by COVID and really hit hard. But all of our residents in apartments, they qualify for the stimulus, or if they went on unemployment, they were actually making more on unemployment than they were at their jobs because we're in the affordable space. But multifamily and commercial real estate provide scale, the ability to have some control. Unlike the stock market, there's massive tax advantages, leverage, and that need. And the one thing I did want to go into a little bit of detail about that's very interesting, that I think that could apply to a lot of business owners on this call, is that there are some very intriguing opportunities in opportunity zones. And I'll briefly talk about that. You're seeing hedge funds, REITs, come out with these new investment opportunities. And because it's so compelling, if you have capital gains, and what that allows you to do is reduce your current capital gain, defer actually having to pay that until 2026, and your new investment moving forward, if you hold it long enough, there is no capital gain on that new investment and there's no depreciation recapture. So again, if you have a business that you're about to sell, or you have a highly appreciated stock, or you invested quite a bit in the market a year ago, this is very appealing in my opinion. Meaning if you invested 100,000, it's now worth 200, and you sold that $100,000 capital gain, if it's a year or more, could be reduced, not a lot, but 10%. So that obviously is an incentive. Moreover, you don't have to pay that capital gain until 2026, maybe later. So there's a time value of money component, and the new money that you invest in an opportunity zone project. And let's say in that example, it's 200,000, you hold it for 10 years and then it's worth 400, that new 200,000 in capital gain is eliminated. So talk about incentive there. Wow. And again, Shakiba Capital, we're targeting that, and we've got a project that we're excited about that is in an opportunity zone. So reach out if you want to talk about that. And then look, here's another part of my thesis is that I think our population is being changed before our eyes. There's being a fundamental redistribution from areas like California and New York. It was already occurring if you look at the U-Haul data, but COVID has accelerated it as more people don't want to live on top of each other, and companies, perhaps more importantly, are much more willing to have people work from home. And so I think you're seeing an influx of people that are moving to states that it's more affordable and the taxes are better and they can get much more and they're not living on top of each other, et cetera, et cetera. So we'd love to talk about real estate. That's a passion of mine. And I can talk about that for the rest of the webinar. So next slide. I did want to cover this again. We did this in the last webinar, and it's to me, it's the most powerful investment concept, and that is tax-free compounded wealth. So you don't want to let taxes only affect your investment decisions, but when you can compound your investment like an opportunity zone or a Roth IRA or another tax-free instrument, you've got to take advantage of it. And when you combine that with where taxes look to be going, you want to have as much of your investment portfolio in a tax-free position moving forward as possible. Because what we're talking about here is a multi-generational wealth opportunity. It's not just you, it's also what you can pass on to your kids and grandkids potentially. So Roth IRA, that's the easiest one. I'm sure there's a lot of people on this webinar that perhaps don't qualify because they make too much money. But there's some really unique strategies on how you could get one, whether that's conversion, whether that's rolling over an old 401k or another retirement plan that has after-tax assets. Something that I do is I pay my kids every year. And we do that with the help and advice of our CPA, but we pay that to them. And then we fund their own Roth IRA. So talk about wealth accumulation from a very, very young age, and it benefits you as a business owner, something everybody should be doing. We talked about lower taxes right now, potentially. You may even have lower income. Certainly in 2020 and maybe 2021 due to COVID, now's the time to look at converting a traditional or pre-tax IRA because you're going to be in a lower income bracket. So I think everybody would agree that look, taxes are going up more than likely, and it'll probably be next year. And look, there are much more advanced strategies with how your business is set up. And that's where exit advisors, tax attorney, and CPA would come in. Probably don't have the time to go into that in this webinar, but some really interesting and unique opportunities. And we were talking about this before the webinar started, but selling your business at a capital gains rate at 15 or 20% is way different than selling it at 25, 30 or more if capital gains return or goes to ordinary income, which they're talking about. Huge, hundreds of thousands, if not millions of dollars of difference there. So next slide. And to really bring this to a conclusion, and I hope there's lots of questions, I thought, you know what, let me share how I approach investing. And this is just from learning from some fantastic investors, doing it for 15 years, seeing behind the curtain on how some incredibly wealthy people approach their money and their investments. And this is just how I do it. And I can give you my perspective here, and you can agree or disagree or tell me when I'm wrong. But I think it's important, especially for the business owners, because you're about to have a liquidity event. For some of you, it's going to be the biggest event, and it's very important that you get it right, because this is your retirement. Some of you may start up other businesses and do it all again, but I think it's important because it's different than an individual that's working at a company for 30 or 40 years and they're saving through their 401k and they have a pension or whatever. So my approach is 4 ways. Number one, I call it get rich for sure. And, it goes back to what I said. First rule of investing is not to lose money. And number 2 is to see the first rule, right? The objective within any type of investment is to make money. It's not gambling. It's a long-term time frame, and you will do really, really well. Even if you only average 6, 7, 8%, which is below the market and certainly what other investments can provide, but you don't want to be taking risk in this bucket. Now, every investment has risk, I get it, but to me, this is what is the most for sure. And in my category, it's real estate. There's no other asset class like it. I focus on cash flow. I want to get paid to wait. And that's why I'm such a big proponent of multifamily, especially the cash flow component of it. We know long-term that rents are going to go up. We target markets that have job growth, population growth, wage growth, and the fact that it cannot be disrupted is such an appealing component of it to me. And it's a real asset that you can see, touch, taste, if you will, feel, I guess. So that's my first bucket. And, I don't have everything here, but I have a big portion of my net worth here. Second is I believe in the stock market. I did that for 15 years, but this doesn't need to be complicated. Simply own the market and do it in the cheapest, most cost-effective way possible. And I would challenge you here, for those that have an advisor, what is your actual return and what are your total all-in expenses? And be very transparent with you, is that most advisors are not providing any return and value above the S&P 500 index. You would be better off invested and diversified in 5 or 6 index funds with the lowest cost internally, and just owning those and turning it off. And it's going to be up, it's going to be down. But if you do that, and it's equities, large cap, mid cap, small cap, international, whatever, you're going to see 8, 9% long term. But if you're working with an advisor that's buying and selling and trading, I would challenge you to look into that in a lot more detail, because I've seen it so many times when I evaluated clients' portfolios. They're doing a lot of stuff and transactions. It's costly, and they're not adding any value above the market. By all means, stay diversified. And then the real way to play the market, in my opinion, you own it in the cheapest way possible. And then you see a 20% pullback. You want to be liquid enough to put money into the market. Certainly February, March of last year, I think that's going to be, we're going to look back on that as a once in a generation opportunity. But the one thing I can assure you is there's going to be a correction. There's going to be a bear market. We're going to have another recession. There's going to be volatility. And when that volatility occurs and everybody's going this way, they're scared, there's fear, there's panic, and they're selling, you want to be going the other way. And it's difficult to do. I mentioned before, when we spoke a year ago, it was like, holy cow, is the market going to go down another 20%, another 30%? But looking back, that 35% when we spoke was the bottom. Either way, it's still down 35% in that example. It was 35% on sale from where it was. And of course, it's going to recover higher. And so even in that situation, if it goes down further, allocate more. Dollar cost average down into volatility. Next slide. My third bucket is I love disruption. And I don't put everything here, obviously, but I love companies that disrupt and have the ability to change the narrative. So, I put a couple examples there. I love Uber, especially as the economy's opening back up. ride sharing, but look at what they did with Uber Eats. And then they just bought a company called Drizzly, which is alcohol delivery. I think they're going to do extremely well as the economy opens back up. Telemedicine through COVID, that boomed. Zoom boomed. Tesla, the valuation, I get it, is stunning, but their technology is so far ahead and they're disrupting an industry. I think real estate, and not multifamily, but that is an industry to me that's ripe for disruption. Meaning when you go to sell your home, are we going to keep doing it that way in the future where the agent gets 6%? I don't think so. I just think you look at companies like Redfin or Open, it's very intriguing to me. That industry is ripe for disruption. Financial services, ripe for disruption. Streaming, Netflix, that was obviously a while ago. What I look for here is companies that are going to outgrow their multiple, compounding revenue, have the potential for 10x. Eventually, they're either profitable or there's a clear pathway for them to be profitable. But look, this isn't your value investing in this area. If you do that, you'll never buy an Amazon or an Uber or these companies that have the potential to disrupt and grow the top line. And then number 4, I do like and invest passively in businesses. And so everybody's probably familiar with that because you're business owners. I think it's the most aggressive and most risky, but I pay close attention to who the business owner is, maybe equally to what the business actually does. And then I'm always focused on cash flow. How am I going to get my money back? Are there going to be distributions quarterly, every month? Are there no distributions? And I typically don't like passively investing in a business that doesn't have that. Because again, I just want to have that drip. I want to have that income coming in and get paid to wait. And so for what it's worth, that's how I invest, especially exiting out of my firm back in October of 2019. It was my liquidity event. And so I wanted to be really careful, and I want to make sure that I'm making really good investments and staying diversified. So that's, I think that's about all I have. I would love to have a good Q&A back and forth. I'll be as open and transparent as I possibly can. And then I think on the next slide, Andrew, go ahead and mention this. If you're looking to get in contact with me, I have an email and an investor distribution list that I announce new opportunities with Shakiba Capital through that. And I send out what I think is some interesting info every week. I call it Fun Fact Friday. And so if you'd like to get on that, please reach out to me at my email there, or text me, or just go to our website at shakibacapital.com. And we hope to present 2 or 3 new multifamily projects to our investors every year. But we look at a ton, and we hope to really be selective and do the appropriate due diligence to make sure that they're the right types of investments in multifamily projects. So anyways, I'll kick it back over to you.
Yeah, thank you, Trevor, and thank you for the presentation. There's definitely a couple people on here that I would encourage to reach out to. I know we've had some discussions, so glad to have your info and keep a lookout. But 2 things that have come across, 2 questions that popped up during this. The first kind of goes back to your first slide. It's about volatility, and then you were talking about the market recovering and having the most dramatic ups and downs we've ever had. Looking at the VIX now, not to dive too deep into the VIX, but it's at the lowest point it's been in almost 2 years. But when you look at it over a 5 or 6 year period, it's kind of reverting back to where it used to, in the low to mid teens. Question 1 is, where do you see volatility heading? And 2, do you think the market recovered too fast? Was it a knee-jerk reaction to COVID and it warrants being back where it is? Or did we bake too much optimism back into the, to the future months?
Yeah, so I'll answer the second question first. So it's always important in the near term, the market can move up and down for any number of reasons, and it can be extremely volatile. It can potentially go up way too high, which it typically does, and then it goes way too low based on the fundamentals. And we saw that in February, March. We saw that in 08, 09. But long term, the market moves based on one thing and one thing only, and that is earnings. And if you think about it from an individual company, that individual company is going to go up or down long term based on the direction of their profits and earnings. And so in February, March, the reason the market plummeted because there was uncertainty about what the heck was going to happen and how earnings were going to be so negatively affected. And so did we recover too fast? My general answer would be yes, absolutely. And a lot of people would point to the Fed and how that's potentially propping up the market. And I think there's an element there, but that's not as big as what people would point to, because a lot of that money, like in 08, 09, is just kind of sat in companies, in individuals, in particular balance sheet. But look, for the rest of this year, I think the market and the economy is in a very good spot. I mean, I think jobs, the economy is opening back up. I think confidence is returning. People are, vaccines are becoming more and more. I've seen articles and studies that show we're going to hit herd immunity by June or July based on the amount of vaccine. So all of that is very good for your traditional economy. And I think those companies are going to do well. The ones that are opening, the traditional ones that are going to benefit from that. I do think we're in the late stages of this bull market, but there's no way for me to put a time frame on that. 6 months, 2 years. I mean, how much longer is the Fed going to be able to stay and do what they're doing? Soon as interest rates start going back up, everyone should pay very close attention. You should be paying close attention now and taking profits, because look, on my first slide, the Dow was at what was it at? It was at 18,000. We're not that far off from the Dow. And remember what the Dow is. That's not even the best measurement of the stock market. That's 30 blue chip companies. That's almost doubled. The Dow went from 18, or almost doubled. The NASDAQ has by far gone past that. But there's always going to be a reversion to the mean, and value and fundamentals always matter long term. No doubt. As far as volatility, so let me sum up that, Andrew. I think we did recover too fast. I think you're going to see volatility. And like I said in my one slide, you will not be rewarded for speculation. Meaning, if you see whatever new company or whatever that's doing something that has zero profits and they might be able to do something in 3 or 4 or 5 years, you're not going to see just put money in and double, 3 months later, which we saw some crazy stuff last year, especially with the online tech sector. As far as volatility, I think the VIX index, for those that don't know, that's an index that measures volatility. It basically moves the opposite of the market. So it's a great hedge, meaning if you own the VIX and the market plummets, the VIX is going up, right? So a lot of people use that as a hedge within their portfolio. I think the VIX index continues to go down just because I think you're seeing the economy open back up and confidence. And there's a ton of money also. We didn't talk about this. There's just a massive amount of money on the sideline. The statistic that I said before, more money has gone into stocks in the last 5 months than the previous 12 years combined. And so just remember, typically the market moves from like this big circle from greed to fear. Or no, greed, sorry, the top is greed to fear. And obviously we saw that in February, March, and I think we're beginning to come back up to this point. GameStop, more money's coming in. And so I think people need to be very, very careful in the stock market. stay diversified, take profits, consider diversifying out of the stock market, and don't get greedy.
Trevor, I have one question that's coming in. I'm getting kind of a more elaborate detail around it, but until then, I loved what you said about, turning more to the real estate side of things. I loved what the growth you see in multifamily asset classes, the whole work from home, more money possibly going into those. But what are some of the, areas that you think might be more negatively impacted? Like you can't, even before COVID, with the kind of Internet of Things revolution, we're just seeing malls and strip malls and these type of areas just suffering and suffering. And then COVID was kind of the final nail in the coffin. What areas do you see negatively impacted? And then things that are negatively impacted, like a mall, for example, what are some useful ideas and useful ways of using that space, in the future? What direction do you see that going?
Yeah, well, the first point I would make is that, remember, real estate is local. And so where your office space is or strip mall, if it's in Houston or Austin or Dallas, you're doing fantastic. If it's in New Jersey, probably not as much, or certain parts of California. And that goes for all types of real estate, right? So you always want to remember that real estate is local. And I will go back to my trinity, I guess, my three-part, which is so critical in real estate when it comes to markets, is jobs, population, wage growth. If you have those three things, you're going to do really well. I mean, fundamentals matter, absolutely, but that is so important, because if you invested 10 years ago in Austin, Houston, San Antonio, or Dallas, it almost didn't matter what you bought, because we've had so much growth in Texas and in those markets. Now, for your mall question, what's been interesting is you've seen warehouses and Amazon do some stuff with malls. There's a mall down by where I live where one of the retail, I don't know if it was Palais Royal or one of those, someone bought that, an individual investor, and turned it into a storage complex, which is very interesting to me. Storage as an asset class has done so well, and it just boggles my mind, how many people need storage for their stuff. But like our most recent project that we did, it was an apartment complex, 162 units in Northwest Arkansas, which is a booming market. We put 36 climate controlled storage units in the middle of that complex. I think hospitality, there's going to be people that make a lot of money on that, because I think, the economy is going to open back up. People want to travel again when they feel safe. I think you've seen some incredibly discounted prices in hotels, things like that. Industrial has done very well, along with multifamily. There's so much money now that's chasing industrial and multifamily based on how it performed through COVID. But I would be careful with office based on your location, because I just don't know that all that demand is coming back. And I've seen where a number of large companies have said they are not going to need as much office space as they did pre-COVID.
Okay. And then I have a question here from Fiona, and Fiona, I did unmute your mic or give you that option if you want to chime in, but to introduce the question, what are some of the best practices for rebalancing your ETF portfolio? Because I think you've mentioned a handful of low-cost ETFs and that you should buy if there's a 20% pullback or more. But when do you sell and how do you manage going forward? And Fiona, if you want to chime in or elaborate on that, feel free to.
Yes, first of all, it's really a great presentation. I learned a lot. My question would be, because I do really like the way kind of get 5 to 6 low-cost ETFs in my portfolio. I just managing the cash part. And Trevor just mentioned if there's a 20% pullback, we should just pull the trigger and get more. But I always struggled with how to rebalancing or what's the rules I can get them in place, how to manage going forward for just as the ETF portfolio the part, not like the whole investment, but just the ETF portfolio we are managing by ourselves.
Yeah, that's a great question. What we used to do for our clients is we made it a specific time frame. And so it was either every 6 months or every year. And that way it kind of took the guessing game out of it to some extent. But it also, I think, depends on where your ETF portfolio is. If it's in an after-tax position, you want to be aware of taxes. And what I mean by that is that you don't really want to be rebalancing too frequently there, because that's going to create a taxable situation that may not be very good if you have short-term gains. If it's in an IRA, well, that's different, right? It's deferred and you can rebalance every 6 months. Sometimes what we would do with clients is we would rebalance within their IRA and leave their after-tax alone, because that we were trying to not create a taxable event. The way that I do it is I don't really rebalance until there's an event that would cause me to want to change like a significant change. Meaning if your large cap ETFs, you started at 35% and they're now 37, well, that's not that big of a change to make you want to rebalance. But let's say you invested $1 million and you put 25% to small cap and 10% to technology. And a year later, small cap is now 35% and technology is double. Now would be the time to rebalance, because those two asset classes have outperformed so much compared to the others that you want to sell high, buy low, right? So that's the concept that you're doing. And again, if it's after tax, you want to make sure it's at least 1 year, so your capital gains are long-term and not ordinary income. And then one other point that I would make there, Fiona, is that depending on your personal situation, of course, I think having a good cash position is critical, especially now as we're moving into some unprecedented valuations and levels. Because when you see that 20% pullback, you want to have dry powder to invest and take advantage of that. So that's what we would do with clients. That's what I did personally. And the only other point I would make is that, when you see something like a 35% pullback in 35 days and your allocation has 20 or 30% to bonds and cash, that may also be where you lower that portion to 15 or 10% and rebalance into those asset classes that have been hit so hard.
Awesome. Well, thank you, Trevor. And we're pretty much at the hour, so unless we have any last minute questions, we'll let you go. But thank you so much for your time. Again, everyone, there's Trevor's contact information. We encourage you to reach out to him. We encourage you to reach out to us as well if you have questions or want to kick off this process. We will share this and distribute it in probably the next hour or so, and keep an eye out for the future events that are coming in the following weeks.
Awesome. Thanks, everyone.
Thank you.